Hi, this is John Norquay of eWatch 401k. I'd like to take a couple minutes and explain why it is so important to keep track and pay attention to your 401k. If we look at the last 10 years, we'll be able to see that the market has lost 50% at two different times. In the earlier part of the decade, it lost 50% from its high, recovered, and then in the last recession starting in 2008, it lost 50% again before it started to recover. The bad news is that the target funds that are available in most 401ks did the same. You can see when the market goes down, they went down. When the market recovers, they recover. Market goes down, down, and such. So all three of these different things lost 50% at two different times in the last 10 years. It's not a way of decreasing risk. Why don't you want to lose 50% of your portfolio? You can see that if you lose 50%, you have to gain 100% just to break even. If you think about it, if you have $100,000 in your 401k, you lose 50%, you're at $50,000. You have to gain another $50,000 or 100% just to break even. We've designed a system that is, in a perfect world, only loses 10% in a down market. So you only have to gain 11% to break even before you start getting back to new ground. So how does this work? We believe that everything in the world revolves on cycles. All a cycle is a sine wave. It goes up, down, and repeat. Now, in a perfect world, in the down side of the cycle, we would be out of the market, and in the up part of the cycle, we would be in the market. So the first big question is, are cycles really in the stock market? If we take a look at the S&P 500, here's a 200-day moving average of the last 10 years. We can definitely see that there's cycles going on. These are long-term cycles. If you look at the hypothetical and look at reality, you can definitely tell that there are cycles. The NASDAQ is the same. There's a cycle from 99 through 2002 and a cycle from 06 to 2009. Definitely cycles going on. So if that's the case, there are cycles in the market. Can we actually track them? This is simply an algorithm that I've used over the last number of years where the algorithm keeps track of any investment that you want it to. So we watch it every single day. In this scenario, it's the Oppenheimer Developing Markets Fund. When it's light blue, we're sitting in cash. Then it recognizes that we are starting a new cycle and it buys in. Then hopefully it goes up. It recognizes a peak in the cycle and sells. At that point, our account value is going sideways. We don't really care what happens to the investment. In this scenario, it actually went down. But then it started a new cycle. At that point, when the new cycle begins, our portfolio is starting from a much higher point. So it doesn't take us very much to start getting into new, higher territory with our account value, while the fund itself is got a long ways to go just to break even. So how does this look on a longer time scale? If we look at the last 10 years, the dark blue squiggly line is the actual Oppenheimer Developing Markets Fund. You can see it went along, lost a whole lot in the last recession, and then started to recover. But our portfolio value using this algorithm did substantially different. This is the period of time we were just looking at, from 01 to 03. We caught the upturn and then went to cash as it went back down. Over the course of a longer period of time, you can see we catch the left side, or we catch the upside of the cycle, turns light blue or goes to cash on the downside. It's not a perfect system. You can see there were a number of years where it was very difficult to forge new highs in the portfolio value. But the good news is in the last recession, when the market and this fund in particular lost dramatically, our portfolio was sitting in cash waiting for a better opportunity. When that opportunity came in March of 09, the algorithm said to buy right back in, and the fund almost doubled in the recovery. The irony is that when the actual fund itself recovered or doubled, it went from about 100 to 200,000. The portfolio went from about 300 to 600,000. dramatic difference, and that actually is the definition of compound interest. In that same 10-year period of time, the S&P 500, which we so often call the market, went from $100,000 down to about $81,000, just to give you a general idea of the difference. We do believe in diversification. This is using two different asset classes, but the same algorithm on each, and showing you what the portfolio would have looked like. Again, when it's all blue, light blue, you're sitting in cash. You can see there's times when one position was sitting in cash, one position was sitting in the market. But in general, the entire portfolio value, if you started at $100,000, ended up just a little over $400,000. A dramatic difference from the actual market. It's not a perfect system. You might be surprised to hear this, but we were wrong about 49% of the time. But the key again is to not lose a lot when you're wrong, because when we're right, we gained about 16% over the course of about a quarter, or 110 business days. When we were wrong, we only lost about 3.5% over the course of 21 days, or about a month. So again, it's not a perfect system, but keeping track and following a system is huge over the course of time, because the market does move in cycles, and it has a way of taking back what it just gave you. So John Norquay at eWatch 401k, we hope that you come and check out the site, ewatch401k.com. We'd love to have a long-term relationship with you. Thank you so much.